I would want to is that it is very high probability that you are going to encounter a convertible parity calculation question. So good news for you. It's, this is going to be something that we can use to get a point or two. All right. So corporations issue convertible bonds. And when they issue the convertible bond, why do they issue convertible bonds instead of straight debt? Two reasons. One, it will lower the interest rates that they're going to have to pay on the bonds. And so I'm offering you a bond and you say, well, Dean, I know you're offering me a corporate debenture, and I've seen bonds with similar credit quality, similar maturities that pay more than that. And I said, well, Lauren, I'm not surprised that you've seen bonds of similar maturity and similar credit quality that pay more. But those bonds were straight debt. They weren't convertible. The bonds I'm offering you today are convertible. You can convert them into X number of shares of the common. You say, well, do I have to? I go, no, you don't have to convert, but you can convert anytime. I wouldn't suggest, Lauren, that you convert anytime. Basically, what the issuer is hoping is that they hope from 10 years from now, let's make it a 10-year convertible. 10 years from now, Lauren, they're going to say to the bondholders, would you like your $1,000 back that you lent us? Or would you like X number of shares? And what the corporation is hoping is that you're going to say, give me the stock. And that means they don't have to pay back the borrowed funds. So from the corporation's perspective, they get to pay a lower interest, and perhaps they don't have to pay back the borrowed funds. Now, P.S., this represents potential dilution to the existing shareholders. So the existing shareholder has to say it's cool to issue these convertible bonds because, this idea that you as an existing owner have a right to maintain your proportionate ownership. Okay, so we're going to go issue these bonds, and you should know that all bonds are issued at par. You should know that every time we're talking about a bond, we're talking about par. And so now they're going to establish the conversion price. Now, the conversion price is based on par. And typically, the conversion price when issued is going to be higher than the common stock price. So, right now, let's say the current market price of the stock is 38. And so they'd probably issue these with a conversion price of like $40. So let's put that here. And so typically when the bonds are issued, that conversion price is going to be above wherever the current market price of the stock was. And so let's say, boom. Our first major testable point is you can't do anything without knowing the conversion ratio. So it's very important that when you encounter a convertible question, the minute they give you the price, I have to take this real quick because my dad is in the hospital. Hold on just a second.
Okay. I can, yeah.
He's at that age where, he's having cascading health events where, one thing goes wrong and then another thing goes wrong. And it's like, oh, anyways. Okay. So first major point for us in this discussion of convertible bonds is you got to say whenever you're given the conversion price, you need to establish the conversion ratio. And almost every time I see somebody who's messed up on convertibles, this is where they get messed up. They don't immediately say, okay, I need the conversion ratio. Now, if you get a good draw, maybe they give it to you. They might say the conversion ratio is, but I wouldn't count on it, right? I mean, there's, as we said, there's the dream draws and then there's the face of death draws. Based on your pre-study, how to get the conversion ratio?
So I think we would see how many shares we could buy for.
Yeah, well, what we're going to do is we're going to take par and we're going to divide by the conversion price. Really important. When we get done here, we'll put it into taste phraseology. For right now, we're just going through the particulars of what you're needing in terms of a test taker to kind of solve things. And so when we get that, which is really important, we have now established the conversion ratio. So I'm gonna take my calculator. I'm gonna take 100 divided or 1,000 divided by 40. By the way, be careful because remember, if it's a convertible preferred stock, that is going to be not 1,000. We would be dividing by 100, right? So we've got to be real careful on that. So it's a convertible preferred, it would be 100. So now we're back in business. We got 25 shares. That is the conversion ratio. And that is important for us because what we've got to be able to do and where we're heading, test question, is we've got to be able to calculate parity. Parity is when two things are equal. You know, when they're equal, that's what parity means. So that's really important for us. Now, once the bond is issued, it's going to be trading in the secondary market. The bond is going to be trading in the secondary market. So if you buy this bond brand new, you're going to be able to buy it for 1,000. You know, and we just basically said that this would typically be issued. And when it issued, that conversion price would typically be above the current market price, which in my example, I said is 38. And then what they're going to do, the corporation is going to take this money, build the business, and they're hoping that the stock is going to go up as the result of they invest the proceeds into the business. And so now let's say that the stock has gone from 38 to 50. And so now this bond should be trading at a higher price. So here we say, well, if the stock is at 50, so now let's see what would make the bond parity of the bond be. So with the stock trading at 50, so your customer is considering buying a convertible bond. It has a conversion price of 40. The common stock is trading at 50. What is parity of the bond? What is parity of the bond? Now, the way we do that is we're going to take the 25 shares that we can get, and we're going to times it by that $50, that current market price. And as your broker, I say parity of the bond is 1,250. So that is a test question. So I just figured out what is called parity of the bond. And you say, well, gee, Dean, what can I buy the bond for? You know, because the bond doesn't trade at parity. The bond trades, you know, in relationship to supply and demand. So we've just calculated there parity of the bond. So the bond could be trading either below parity or above parity. Listen, Lauren, if it's trading below parity, give me a call because that would be an arbitrage opportunity. Test question, arbitrage is profiting from price discrepancies. And if the person who originally bought this bond at 1,000 isn't paying attention, they originally bought it at 1,000, they're willing to sell it to me for like 1,100. I go, you must be new. You know, your bond is worth at least 1,250, but hey, I'm here for you. Certainly take that off your hands, right? So arbitrage test question is profiting from price discrepancies.
Okay.
We typically wouldn't expect the bond to be trading below parity or even at parity. We would expect the current market price of the bond to be somewhere above parity, right? Because, you know, maybe I own the bond. I bought the bond brand new for $1,000. And when I did so, the stock was 38. And now the stock is 50 and you want to buy the bond from me. And you say, Dean, what'd you pay for the bond? I say, Lauren, none of your damn business. Doesn't matter what I paid for the bond. What we're here to discuss is what you might be willing to pay for the bond. And you say, well, Gene, it could go down. The stock could go down from 50. I go, it could, but neither one of us believe that, or we wouldn't be having this discussion right now. So you're asking me to leave the party and you're asking me to leave early. And it's a pretty happening party. So what I'm going to want is a premium. I want more than parity. So maybe I'd be willing to sell it to you for $1,300. I just made that up. So your client is considering buying a convertible bond for $130, $1,300. So the next thing you're going to get tested on is parity of the stock. And remember what parity means is equal. And so parity of the stock, you're going to have to at least do one parity calculation. And usually what I tell people, Lauren, is you can't be fumbling around with this. So I'm glad that you put this into your tutoring session, because you should be able to bump into this thing, go, whoa, thank goodness I got a parity thing. I know what to do, man. I got to get my conversion ratio. I gotta multiply. By the way, we're not multiplying, we're dividing. More often than not, we're going to be dividing. Right. So now we're going to figure out what would it make sense. So I'm your broker, and I say, well, Lauren, if we buy this convertible bond for 1,300, that's the current market price of the convertible. That's given in the question. So you say your client is considering buying a convertible bond for 1,300. Put that over here. What is parity? What is parity of the stock? What is parity of the stock? Parity again means equal. So as your broker again, I say, Lauren, if we buy this convertible bond for $1,300, that's convertible into 25 shares of common. Remember, that's our 25s. That's our conversion ratio. I say we would be paying the equivalent. We would be paying the equivalent of $52 for the stock. Right? To take my calculator. That formula is very testable, by the way. So 1,300 divide by 25 shares, 52. Now, what that means is that you and I, if we're going to buy this, have the minimum expectation that this stock is going to go from 50, where it's at now, right? Because that's where the stock's at now. And for this to make economic sense for us, we need the stock to go to what? 52, because that's the equivalent of the price we're paying for this stock. If we buy equivalent parity, that's what we're paying for the stock if we buy this bond and convert it into the stock. Right. So now remember, at the end, the corporation is going to say 10 years from now, you can convert anyone you want. You can't go back and forth. But what's really kind of cool about convertibles, they're very popular. And the reason they're very popular is it allows you as a bondholder to switch your status from being a creditor, a bondholder, into becoming a common stockholder. I tell the story, I don't know if you saw it in my lecture on convertibles, but I tell the story, I'm dating myself as the old dude again, but when Starbucks first started, and I saw them kind of, building these coffee shops, I said, who in the heck is going to give them $5 for a cup of coffee? And nobody's going to ever give them $5 for a cup of coffee. And early in their life stage, they issued some convertible bonds. And I thought, it paid a 6% coupon. By the way, 6% coupon was more than Starbucks Common paid, because Starbucks Common didn't pay anything, because they're taking their resources and opening more coffee stores. And I keep seeing these coffee stores, and every time I go into Starbucks, I hand them $5 and I got to fish into my pocket for another couple dollar bills. I'm like, oh my God, did I miss this one? Anyways, they issued these convertible bonds. At the time, Starbucks was a $35 stock. The conversion price was 40. That makes no sense. They had 10 years to maturity. They paid 6%. In 10 years, Starbucks said, okay, bondholders, do you want to switch your status and become an owner, or do you want your $1,000 back? And we know what everybody's going to do. They're just going to do the math. And whatever gives them the most money, you're going to say, I'll turn it into the stock. Kind of cool. Now, by the way, the issuer knows what you're going to do. So, we were talking about, the draw you get on the test, but Starbucks kind of knows whether you're going to ask for your $1,000 back or whether you're going to ask for the stock. For example, the stock is still 38x at maturity. You're going to say, give me back my $1,000. I saw a guy being interviewed. He's a, billionaire guy, and not Starbucks, but he had borrowed billions and billions of dollars, and people were concerned about his business. And he said, don't worry about it. I'm not going to pay anybody back. And everybody said, well, what do you mean you're not going to pay anybody? He goes, no, all my debt is convertible. I'm just going to make damn sure that I work hard. And at the end of the term, if I say, do you want your money or do you want the stock? I'm going to make damn sure everybody says, give me the stock. And then, by the way, I wish I had a vision like this. I don't. But he said, and then they said, well, you're going to be massively diluted. He goes, I will. He says, but I'm going to own a much smaller portion of a much bigger pie. you know, Howard Schultz, for example, when he bought Starbucks, lock, stock, and barrel, there were 8 stores and he owned 100% of the business.
Wow.
He's been massively diluted over the years because they've issued more and more stock, right? I had the honor and privilege of tutoring the grandson of the founder of Little Caesars, and the founder is his dad is his grandpa is the founder, and you know, he's basically getting his 7 so he can manage the family money. Long story short, I was telling him the story, and then he told me that his grandpa missed Starbucks like me. And I said, well, if your dad missed it, your grandpa missed it, it's probably to hundreds of millions of dollars. Where if with Dean, it was like 100 bonds of my retirement plan that I didn't buy and was thinking about. That's a different scale of that. And then I thought it was so hilarious. He said the reason his grandpa passed on buying Starbucks is because he thought, who would pay $5 for a cup of coffee when my grandpa will sell him an entire pizza pie for $5? The pizza was a much better deal. Okay, well, I guess everybody has enough different unit of delivery in terms of their monetary unit. Okay, so in this convertible question here, is there anything else you'd like to discuss on this? Let me just go back and just put this as a test question for you again. So your client is considering purchasing a convertible bond for $1,300. What I'm kind of saying here is this is the more likely scenario that you're going to encounter on the test, is this one. You know, you're more likely to get parity of the stock than parity of the bond. And they just point blank ask you parity. They say, your client's considering buying a convertible bond for $1,300. The conversion price is 40. Bastards. I don't need the conversion price. I need the what? Conversion ratio. So as a test taker, the minute you get that price, you got to say, man, I gotta stop. I got to reset the par and I got to get that conversion ratio. You know, if it's given to me, I go, oh, thank you very much. So, you know, you got to be looking for that conversion price and then get the ratio, or they give you the ratio. What is parity? Well, let me give you the most hellacious version of this. So I'm about to give you the same question, Lauren. I'm just going to dress it up. I'm going to make it look really more complicated than it is. But are we clear? This is actually the same question. So
yeah,
let's go through it slowly after I give it to you. So now I'm going to turn into a whole paragraph. If a convertible bond is trading at a 30% premium to par and has a conversion price of 40, and the common stock is trading 2 points below parity, what is the common stock trading at?
oh geez.
By the way, now it's the same question, so let's break it down into its component parts. A convertible bond is trading at a 30% premium to par. So you say, okay, well, 30% of 1,000 is $300. Right. So now I just got this thing. So let's just now put that. Let me get my little thing out here. Let me change my colors here. So I had to get this. Right. I said 30% premium to par. I say the conversion price is 40. So then I say, okay, bastards. I like when I'm doing tutoring sessions. I mean, because you can just not hire me to tutor again. But I said that with a company that was pretty woke, and oh my God, they got so mad at me. I'm like, oh, she was joking, you know, I'm sorry. You know? So anyways, I probably should clean up my language, but you know, oh well. And then the other thing I said is, I said, you know, that I was quoting somebody else. I didn't say it. I was quoting somebody.
You should cite your sources next time.
Yeah, I said that somebody said this, and then they said, did you say that? I go, I didn't say that. I was quoting the person that did say that. So anyways, so we said the next thing we got to do, and we said this is really important for us, is that when we get this conversion price, we got to get this conversion ratio, right? So convertible bond is trading at a 30% premium to par. It has a conversion price of 40. Then we got to get the ratio. The stock is trading 2 points below parity. So that means now I got to solve for this, right? And then the stock, what is a point? How much is a point in a stock?
$10?
No, in bonds, it's $10, but in stocks, it's $2.
Oh, what the heck?
Yeah, so that's why I told you that's about as nasty as I think you get, right? So The answer on this question on your exam would have been $50. So let me just repeat, this isn't the nastiest version of this you could possibly get. Again, it's the same content that I have on the whiteboard. I'm just dressing it up with vocabulary and, words, word salad, and, and then you got to kind of dig your way through the word salad, kind of figuring out what's pertinent. So let's just go back. Your customer is considering convertible bond is trading at a 30% premium to par. A 30% premium to par. So 30%. So I could simply get my calculator, 1,000 times 30%, $300. Right? I told you I'm arithmetically challenged. So on the test room, and they're going to give you the calculator. And I always regret when I don't reach for the calculator.
Yeah.
I can't tell you, Lauren, how many people watch one of my videos on YouTube and Dean makes arithmetic mistake. And they jump me, they're on the comments, and then they don't catch me, but I catch myself about 2 minutes later. The math doesn't play out, and then they say, "Oh, sorry, and I fixed, you fixed it." So now the other thing I would warn you about, though, sometimes on the test, the wrong answers, if there are ways to mess it up, it could be one of your choices, and you feel good even though you still missed it. So you got to really kind of be, clear here. So 30% premium to par. So we got that part. It says the conversion price is 40. And the one thing we want to be able to do is when we get the conversion price, we need to establish the conversion ratio. So when they say conversion price, the minute that you get a convertible question, you get the conversion price, you got to stop and say, okay, that's based on par when it was originally issued. So you got to stop and say, okay, par's 1,000. Now I'm back in business because now I got the 25 shares. And that's going to be really important that we have that. Okay, we're still not through this thing, right? So it said a convertible bond is trading at a 30% premium par. It has a conversion price of 40. We're just trying to, so far, just pull out all the information we need to actually answer the question. Now, this is not a straightforward parity calculation. This is now saying, remember, now we're to the part that matters. If the common stock is trading 2 points below parity, so that means we have to calculate parity, right? Because if we don't calculate parity, we don't know what 2 points below it is. And so we calculate parity and it says 2 points below. And then we need to know that in a stock, a point is $1. If I say, Lauren, your stock's down 2 points or up 2 points, that's $2. Right? So that's what we had to do. That's about as nasty as a version of this as I think you could encounter. Now, the other thing I would tell you is that you should be prepared to calculate this as it relates to deciding whether you want the stock or not. Right? What I mean by that is you should be able to take whatever the current market price of the stock is, in this case, 50, and times it by 25 shares and say, well, no, I don't want my $1,000 back. I want, the stock, right? And if we did 25 shares and it was less than 1,000, then we'd say, no, I want my $1,000. So if parity of the stock is below par, then we're going to say, give us back our money. One other point we're trying to get to, we're trying to prepare for a face of death draw. And on a face of death draw, this is not a taxable event to convert into the stock.
It's taxable when the sale of stock.
That's exactly right. So I say, hey, what do we want to do, Lauren? Do we want to convert? And you say, Dean, what are the tax consequences of converting the bond? I said, it's not a taxable event. Taxable event is when we take the stock and then we eventually sell the stock. That's when we're going to have sales proceeds. We don't have any sales proceeds by converting the bond. All right. Any other questions on this one? You want to try another one?
Yeah.
Okay. So let's try another one. So a convertible bond is trading at 110. It has a conversion ratio. Conversion price will be nasty because sometimes they give that to you. Let's assume they don't. A conversion price 50. What is parity of the common? All right, so we're going to ask you parity of the bond or parity of the stock. Here I'm also being a jerk again because I didn't say parity of the stock. I'm just, again, making it sound different by saying parity of the common. So again, what is our first thing we must do?
The conversion ratio.
Yeah, we got to get the conversion ratio, right? So how are we going to get the conversion ratio?
1,000.
Right on.
50.
And we're going to divide that by,
$50.
that's right on. So $50. And that gives us the conversion ratio, which is, I think it's 20 shares, but I told you, I don't trust my arithmetic. So I'm going to, yeah, 50, whoop, 1,000. I think it's 20 shares, but let's see, 1,000 divided by 50, 20 shares. So now we're back in business. All right, so the next thing we got to do, and as I said, that's really key. You know, the biggest thing I told you, I don't know if I don't want to be sending out negative vibes, but the biggest thing people get hung up on as test takers is they don't get that ratio. And without the ratio, you're just going to kind of be stuck. You're not going to be able to do anything, right? So once we have the conversion ratio, now we're back in business. As we said, what we're going to do is we're going to take the current market price of the convertible. Now you need to know that 110 is 110% of par. So that's 1,100. Right, that's what that is in bond speak. And then we're going to divide that by
20.
right on, right on. Boom. So we're taking the current market price of the convertible and we're dividing by the conversion ratio. Let's just label that. So let me get out my different color here. Let me get a smaller font. So, whoa, I don't want to do that yet. Whoop. So we want to label that. That's the current market price of the convertible. And we're dividing that. By the way, as I've always said, if you can't decide what to do on the test, divide, right? If you can't decide what to divide, take the first number divided by the second number. And we find out that if you buy this bond and it's convertible into 20 shares of the stock, you'd be paying the equivalent for the stock of 1,100 divide by 20, $55 is parity of the common. And we would expect that the stock is probably trading, 53, 51, somewhere like that. I mean, again, if the stock was above 55, there'd be an arbitrage opportunity, right? Because if the stock was like 60, I'd buy the bond, convert it, and then, sell the resulting stock for the $60. So that's parity of the stock. And as I mentioned, I can't imagine you're not going to be asked to calculate parity at least once, maybe twice. And then, I could think I wouldn't be surprised if you actually told me you had 3 questions on convertibles. That'd be high, but it's within the realm of possibility. Because remember, the other thing I told you got to be prepared to do is to tell the customer whether he should take his $1,000 or whether he should get the stock. So they have that scenario as well as a test question where at redemption or at maturity, what should the customer do? And then you got to say, okay, well, I still have to figure out the 25 shares versus the price or whatever. And say, if it's less than 1,000, he should take the money, redeem the bond. If it's more than 1,000, he should convert into the stock. Now, by the way, he doesn't have to wait till the end. He can convert anytime he wants, but it wouldn't be something that I would recommend to him. Again, dating myself, but one of the most successful investments I made for myself and my clients over the years was a convertible preferred stock. The only thing I really am mad about is I didn't think laterally and think, where else could I do the same thing and make some more money? But anyways, the stock at the time was a $7 stock. And they issued a convertible preferred stock with a conversion price of 10. That makes no sense, right? It makes no sense right now to convert at 10 when the stock's at 7. But it had a nice, juicy preferred stock dividend. Woohoo! So I'm getting a dividend, which I'm not getting on the common. Anyways, a much larger company bought them out. And what I thought was funny, Lauren, is they asked me politely if I'd like to convert and tender my shares. And I said, no, I would like to stick around another year collecting that dividend. It's even better now because you're on the hook for the dividend and not that previous company. They can't make me give it back. Remember this call? They can't call that away from me for another 2 years. So I got 2 more years to collect my dividends. But I thought it was funny, Lauren, after after the call protection period had passed, I didn't get a nice please letter. I got a, you jerk, here's your money or your stock. I wondered though, Lauren, myself, how many people who didn't read the tender carefully just said, "Oh, okay, I'll give me the," I go, no, I got some more time here to collect my, my money. By the way, that would have been a huge percentage difference in return based on converting too soon. So what I'm saying is I would tell my client, why would we want to convert when we're getting paid to stick around here and just see what happens? Right. So typically, even though you could convert anytime you want, you can't go back and forth. But, we would typically wait. And then I said they might force us by calling. So same thing at redemption or call. So now it's past the call protection period. Again, I say, Lauren, what should we do? Should we give them back the bonds or should we convert into the stock? Again, it's just based on the number, right? I'm going to say, well, if the call price is better, I'll take that. And if not, I'm going to convert. All right. So ready to move on to spreads?
Yeah. Mm-hmm.
Ooh, spreads. Well, spread means the difference. So that's our first thing. Whenever you're asking somebody what's the spread, you're asking about the difference, right? So what's the spread tonight? And what I'm betting on is the difference in the scores. In our case, it's going to be the difference in the premiums. But that's what spread means, difference. And if we are going to bet on a game tonight, some people want it to be within the spread. If the spread is 10 points, some people want it to be narrow. They want it to be 6 or 7. And some people are going to want it to be outside the spread. I don't bet on sports as much as my friends do, Lauren, and I forget that they bet on sports because sometimes they get so worked up and I'm like, what the heck are you worked up about? It's no big deal. Our team won. Mm-hmm. No, that last 3-pointer, man, it went outside the spread now and I didn't win. Oh my God. No. I have friends who will bet. I thought, I'll say something like, I thought you were rooting for this team. And he goes, well, yeah, I'm rooting for that team, but I got that player. I'm like, oh my God, too complicated.
I don't get it either.
Too complicated for me. So, all right. So let's get a stock price here. And remember, in our option strategies, we're either a speculator or a hedger. And with spreads, we are speculating. And in general, when we're speculating using options, in general, we're either buying directional volatility or we're selling directional volatility. So volatility is either our friend or it's our enemy, right? So if we just buy Apple today is 160. And if we just buy Apple today, Lord, at 160, we only have to be right about one thing, Apple goes up.
Mm-hmm.
And we don't have to be worried about the timing because, the stock doesn't expire, right? But if we buy an option on Apple, we got to be right about 3 things: direction, how far, and timing.
Yeah, that's a lot.
If we mess up any of those 3 things, we're a loser. Now, if I sell an option on Apple, I sell the volatility. I start with a little bit of an advantage because I just need to wait for you to kind of screw up. Now I say, well, listen, you may be right, Lauren, for example, let's say it's a call contract. I say, Lauren, you may be right that it goes up. You may be right that it goes up, enough to cover your out-of-pocket cost. And you might be right about the timing, but I don't think you're getting all 3 of those things right. The biggest thing to screw up is the direction. So I'm going to tell you what I'm going to do, Lauren. I'm going to sell that volatility to you. I'm going to sell or short. Now I got to decide how many shares of Apple do I want to be a potential victim on. And so I'm going to sell 1 Apple. I got to decide how long I want to be a potential victim. Longer term options have greater premiums. So if I'm going to be stupid, I may as well, go big here, right? Mm-hmm. So we're in March, so maybe I go out to August. And let's say I do an August 160 call at 11. Now that's just a basic option strategy, right? And if I just asked you about this on the test, that's all I asked you about, you'd say, Dean, this is a bearish transaction. Bearish, meaning I want Apple to be 160 or lower. is that I get to keep the money. My max gain is the premium I collected. Every time I collect money, that's the best case. My maximum loss, is unlimited. That's not bueno. Now, what I'm going to do here, what I like to do, again, process, I like to put underneath this what I'm looking at. And what I'm looking at here is an obligation to sell the stock at the strike price. So I like to get that going there so I can see what I'm looking at. And as I said, this is not very smart. It's not very smart because if you're wrong, you're going to lose all kinds of money. This is money in. So let's put that there. Now, some people like to use, instead of money in, some people like to use credit, whatever floats your boat. Some people like to use a plus sign. I personally like to use money out versus money in so that I don't mess up on, tracking zeros and so forth. So this is just our basic option strategy. And then what I like to do as well is I like to get a T fired up. A T fired up so I can, kind of track the money. So I'm going to get a T fired up here. If you're not struggling with contract specifications, in other words, you can look at this pretty quickly and say this is an obligation to sell the stock, and you can track money, you're going to be in pretty good shape, in terms of what's going on here. So, and again, some people like to use credits, whatever. I like to use dollars in versus dollars out. But again, whatever floats your boat. Is this an opening purchase or an opening sale? So far, are we looking at an opening purchase? Are we looking at an opening sale?
An opening sale.
Excellent. Excellent. And, if we're going to have advanced option strategies, multiple option strategies, we might want to get a little tighter on our T, because we're going to have a lot of things going on. When you got a lot of things going on, your process becomes a little bit more important about what's going on. And so, again, I think we should do things on a per share basis. So I'm going to put 11 there. But, we could have, if we wanted to, we could have put 1,100 in there. If it was 10 contracts, we could put 11,000. I just think it's a mess. So I personally recommend we do things on a per share basis. And then when we're all done, say, okay, well, how many contracts are there? Okay, so the problem with this position so far, that this is a naked call. And that is really foolish. And I always joke, don't be a dumb bear. And this is a really dumb bear, because here there's a floor. Now there's a floor there at 160, but there is no ceiling. There is no ceiling. And so what I'm about to do is a spread. And our first test question about a spread is, can we identify it? Now, even if that wasn't a test question, I just told you it is. But even if it wasn't, I just told you it is. If you can't identify it, you're going to be looking at it going, I don't know. Right? But it is pretty smart of myself. So, you know what, in case this thing blows up on me, I think I'll put in a ceiling just in case. Now, the conversation I'm having with you is not testable. Everything I put on the right-hand side of the whiteboard is testable.
Okay.
You identify a spread. A spread is when you're long and short the same type of contract. So what is testable is I just told you that I'm about to turn this into a spread. What I'm spreading is the difference in the premiums. So you should kind of be able to say, okay, well, this is going to be a spread, and Dean has sold the call or shorted the call. Then that means the next leg, not testable, but if you want to sound like a player, that's called a leg. Right. So press your option, friends. I'm legging it. What we're doing is called legging into a spread. We're legging into the spread, because right now we don't have a spread. When I teach series 4 and series 9, I say, listen, we love spreads. In fact, we might even call you and say, Lauren, listen, I had Dean Tenney here, registered option principal. Are you serious? You want to sell a 160 call naked? Really? That's what you're trying to do? I mean, Lauren, that kind of makes me think as a registered option principal, you don't know what you're doing. Are you familiar with credit call spreads? Lauren, a call spread is a way to take the money without taking all the risk. So, I keep in my lectures, I always say, don't be a dumb bear. There's smarter things to do. So we're going to go buy or go long one. So here we go. We're going to implement the spread. We're going to buy one apple August. Now we've got to decide at what price do we want to put in the ceiling. Because what we're
190.
basically doing here is we're offsetting our obligation with a choice to buy. And so we had a choice to buy at 170. That would give us greater protection than at like 175, for example. But, it's going to cost us more money. I don't know if you've met my friend, Brian, the test geek. He's a good friend of mine. And he always says, well, Dean, I think you go overkill on options. I go, maybe I do, but he doesn't think there's 20. And the other day he told me, and I, listen, he's a good guy. I believe him, but he says he thinks almost always it's a 10-point spread, 10-point thing. I go, I'm not so sure I believe him on that, but hey, we'll go for the 175s. And so we're going to go for the 175s. Again, the conversation isn't testable. And we're going to pay out this money. The whole point of doing this is that now we have offset our obligation to sell the stock with a choice to buy. Pretty bueno, right? By the way, I always like to, in terms of process, and I like to put above the leg here what I'm doing. So this would be on my scratch paper. I would take it off my screen and put it on my scratch paper for analysis. Right. So, they would say your customer buys one apple, August 175, call it 3, and sells one apple, August 160, call it 11. When Apple's at, who cares? Doesn't matter where Apple's at when we do it. And this is a choice. I don't like this. I want to keep this clean. So it looks like I accidentally moved my spread in here. I like to stack my legs. Again, the conversation is not testable. But the reason I like to stack my legs is because it makes it easier for me to do my analysis based on this floor and the ceiling. So, what I'm saying is I would take this out of the format they give it to me and put it on my official scratch paper, dry erase paper, to make my analysis. So this is me just putting it in a format that I like to have it in. So I'm going to stack my legs here. So I have them on top of each other to make my analysis a little easier. And we said we're going to do this one, and we're going to get pay 3 for this protection. Okay, so as I said, I always like to also put above and below, what I'm looking at. And here I'm looking at a choice to buy the stock at the strike price. XP means strike price. So now I've got test question number 1. You should be able to tell me that you're looking at a spread. That's test question number 1. Now, test question number 2, what we want to do now is we want to say, okay, well, let's look at this part of it. Is that money out or money in?
Money in.
That's going to be money
out.
Right on, right? And so some people like to call that a debit. Some people like to call that a minus sign, whatever floats your boat. And then, as I said, I want to be really kind of disciplined when I've got a lot of things going on. Because if you get good at a T, by the way, if you get good at a T, you can track the money in and out of the account. And even if you're struggling, you can kind of figure out what's going on. If you're good at contract specifications and you can track money, you don't need to memorize anything, actually. You could just kind of do this. So now I'm going to put my 3 over here. Now, the other reason, again, this is a tutoring session, so I'm going a little more in depth with you than I do like in my videos and stuff. But the other reason I like the T, so I'm giving you a lot more backstage stuff. Hopefully it doesn't confuse you, because that's obviously what bad tutor Dean would be if I'm making you more confused. But the other reason I like the T is it helps me kind of in my own mind know what the offset would be. So you were absolutely correct when you told me that it was an opening sale at 11, right? And this is an opening purchase. And the reason I like to be able to do that is because if I go to close it out, I want to kind of know, if they say several weeks later, Apple's at, or, at expiration's Apple at, I got to know where I got to plug things in. if I'm going to offset. So that's kind of why I like that T as well. Okay, so test question number 2. After we've identified it, test question number 2, is it a credit or a debit spread? Is it a credit or is it a debit spread? So let's put that there. Let's put this here. And so do you recall how we determine whether it is a, I'm just cleaning up my slide here. How would we determine whether it is a credit or a debit spread? Now that's going to be important because that piece of the analysis, if we get that right, man, we can rock and roll if we get this piece of the analysis correct. So now we want to determine whether it's a credit or whether it is a debit. And the way we do that is we're going to net the premiums. Debit means money out. Credit means money in. I kind of think of like my checking account, right? You know, again, I'm talking backstage, Laura. But, you know, I love my booking page, right? You know, because for you, that's a debit, right? $225 debit. And for me, it's a credit, 225 credit, right? I see the boom, you know. I'm kind of lazy, I got to tell you, Lauren. The other day, good news, I don't have a hard stop today, but you know, I could tell people get upset when I'm whining. I was like, "What do you mean you're whining? You know, got all kinds of people paying you all kinds of money." I'm like, you know, I don't like working that hard. You know, so today with you is pleasurable because I know that you know I'm not got 5 people stacked behind you.
Yeah.
But anyways, you want to exercise, right? You know, I'm kind of proud of you in terms of what you want to get done. You got your agenda and you need to make it happen, right? Because you're starting with having money out of pocket, right? So what we're going to do that is we're going to net the premiums. We're going to net the premiums and we're going to establish from the netted premiums. Now, remember, before we turned into a spread, we kind of know that volatility is either our friend or our enemy. You know, what I mean by that is that if I am somebody who's selling option positions, I'm a potential victim and I don't really want to be victimized. I want the contracts to expire so I can go neener, and I can keep the money, right? So if we net these 2 premiums, whether we use pluses or minuses or dollars out or dollars in, this is really important for us. We establish test question that this is an 8-point credit spread. You know, and again, you know, some people use training consultants. You know, Tina is the person at Training Consultants, and I had made a video where I used Tina to mean there is no alternative, not Tina, the training consultants person. But I said Tina is dead. I meant the idea that there is no alternatives is dead. And then everybody's like, Tina's dead. I go, no, not that Tina, the Tina. But anyway, she teaches a little different with pluses and minuses. And people call me all the time using training consultants and say, Tina does it differently. I go, if you do the math, she's doing the same thing I'm doing. So you just got to be careful too when you get too many voices in your head about how to do things. I have a process that I'm working with here. I call it don't hate the 8. Don't hate the 8. There are 8 things you're held accountable for on a spread, and that's what we're working our way through. We've done one of the 8 things. Now, again, regardless of what they're asking me, when I'm practice drilling and rehearsing, I want to do all these things. Because if I do all these things, I know that whatever they're asking me for, I've got the answer. So it's important for us to have established at this point that indeed this is a credit spread. This is a credit call spread. So that's important that we've established that this is a credit spread. Now, the next thing we need to do, our third of our 8 test questions, is to determine whether we want the contracts to expire or exercise. Do we want the contracts to expire, or do we want the contracts to exercise? Now, when you get good, you know, maybe you don't need to be menu driven as much as in the beginning. But in the beginning, you know, I would suggest you stay menu driven. What I mean by that is at some point when you get good, you can just kind of look at it and say, well, gee, if it gets exercised, I'd be buying Apple at 175 and selling Apple at 160. That doesn't sound bueno. That sounds kind of bad. But until you get to that, you want to stay menu driven. And good news for us, once, as I said, we get these things, we can really rock and roll because we're going to have send and we're going to have do. And that goes together all the time in terms of what we're doing. So here you would tell me on the test that you want these contracts to expire so you can keep the money. As we said, the best case is you agree to be a potential victim. Nobody victimizes you and you go neener, neener, neener. You get to keep the money. So that would be absolutely what we want to have happen. So the hardest part, by the way, let me just show you real quick what I mean by that. If these contracts expire, by the way, that happens if Apple's 160 or lower. I would be a happy camper. You know, I think you're kind of a jerk of a customer, Lauren, if you say, well, Dean, had I done the naked calls, I would have made 11, but now I only made 8. I said, well, yeah, but true, but you would have been taking all kinds of risk. You know, it's not about what if you're right, it's about what if you're wrong. Now, the hardest part, by the way, but the reason I wanted to show that to you is because the difference in the premiums, have narrowed from a difference of 8 when we established the spread to now a difference of 0. You know, that's the hardest part to get. Don't need to get it. What I want to have happen to these contracts is I want the difference in the premiums, test question number 4. I want them to narrow. I want that difference to get smaller. The most it can narrow to, as I just showed you, is when the contracts expire. And so what I want to be able to do is have those contracts. By the way, those words go together all the time. All right, so that's going to be something we want to be able to do. Once we get that, rock and roll. Credit, expire, narrow. Let's put that here. How often will you be right? All the time. All the time. Now, I'm going to show that to you. And just to kind of illustrate it to you, but remember, it's not really, you know, can you do that? It's just, do you know it? It's an aim and shoot, point and click question. But, you know, if we open this up, here's when we open this thing. When we open the spread. And so when we open the spread, we paid out 3. Well, let's put that in red. And we brought in 11. And so we established this for a net credit of 8. I'm just showing that to you here. Let me put my line here. Boom. And now I'm going to close it out. And you were pretty good at this. Again, I was pretty pleased with your understanding of how we open and close options. And so, you know, now we're going to close it out. Or there's 3 things that can happen in options contracts. They can be traded. They can be exercised. So now we're going to close this out. Now we're hoping the difference when we close it out is smaller. By the way, what I'm showing you is not testable. What's testable is if Dean shows you that that number is not an 8 anymore, but that number is a 6, we're going to make 2. If I show you a 4, we're going to make 4. If I show you it's a 12, we're going to lose money. So we need that difference, that spread, the difference in those 2 numbers, that's what the spread is, to narrow. So now let's close it. I'm just arbitrarily going to make up a price to close it. Now we're way north of where we're at right now on the 8, don't hate the 8. We're on item number 4. But that being said, I say when closed, and let's say I'll just make up a number. We're going to close it with Apple at 162, and we close out for intrinsic value. So now that's going to be -2, right? That's the intrinsic value of that 160 call. And that's, we sold it for 11 and we were able to buy it back for 2. So in that part of the transaction, we made 9. Let's call this over here. Let's call this net result. Boom. And again, we're going to put this here. And the intrinsic value of the 175 call. And again, I think you're kind of a jerk of a customer if you say, well, Dean, we wasted our money for the 175. I said, it wasn't a waste. That was that ceiling we put in to protect ourselves in case we were wrong and this thing widened. By the way, the most it can widen to would be the difference in those two numbers. We're not where we're at right now. I'm just way north of where we're at right now. But the net result here is 2 out. We'll put that there. That's our net result here. Whoop. And so it narrowed, the difference narrowed from 8 to 2, from 8 to 2. So we made 6 points. By the way, here we lost 3. I'm just showing you what this looks like in terms of this concept, right? So whether I go vertically or whether I go horizontally, I'm just showing you here that we got more money in than we got money out. We're winners. And that's the hardest part to get. As we said, you don't need to get it because credit, expire, narrow goes together how often? All the time. Now that means consequently that this is going to go together all the time. So, right now I'm showing you a credit spread, and if you had to guess what I'm going to show you next, it would be a debit spread, right? Because you said you want to see a credit spread and you want to see a debit spread. So we now have done 4 of our 8 things. 4 of our 8 things. Number 5 of our 8 things. We have to be able to get max gain. And number 6 is we have to be able to get max loss. So that's number 5. Number 6 is going to be max loss. These are the things we have to be able to do. And let's put this one in red. Now, one of the tricks about max gain and max loss is that the gain and the loss always equals the difference in the strikes. All the action takes place between the floor and the ceiling. That was the whole point of us doing this transaction. You say we want to play between 160 and 175, and we don't want to play no more. Now, I think the easiest way to proceed is determine, we've said one of the common themes is when you collect money, the best case is you get to keep it. And so if it's a credit spread, I'm going to say, okay, well, I think I'll go with my gain first because I know that when I collect money, the best case is I get to keep it. Now, if it was a debit spread, which I'm going to show you next, I'd say, oh, that's my loss, right? And whatever one's easier for you to get. But what I'm saying here right now, and this is really important for us, I think, to help us make our life easier, is that these gain and the loss is always going to equal the difference in the strikes, because that's the whole point of a spread, is we're saying that we only want to play between 160 and 175, and then we don't want to play no more. Right? So these gain and the loss here is going to equal the difference in the strikes, which in this case is 15. All right, so let's put that there. Let's label that. That's the whole point of a spread. So as a test taker, we can eliminate anything offered to us as gains and loss. If they on the test, they say, what's the gain and loss? We as test takers can immediately eliminate anything offered to us that doesn't equal 15. Because the gain and the loss has to equal 15. Now we already have the max gain. We know that when we collect money, the best case is we get to do what? Keep it.
Mm-hmm.
That's as good as it gets. So that's kind of helpful now, because now we have that max gain. So our max gain here is, let's put that in here, is the net credit. So that's test question number 5. What is the maximum gain? And here it's going to be the net credit. In our example, the net credit is the 8 points. So if Apple's 160 or higher, 160 or higher, we get to keep the money. We get to go neener, 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 and we keep the 8 points. Now, the reason that's helpful is because we know that the gain and the loss equals the difference in the strikes. So that means something, remember this from grade school? Something plus 8 equals 15. Now, just by way of reminder, before we turn this into a spread, Laura, we could make 11 and we had unlimited loss potential. But now there's a ceiling at 175. So the worst case is we're going to buy the stock at 175 and deliver at 160. We're not happy because we'll lose 15 points, but what's already in our account? 8.
The premium.
Yeah, so the most we can lose here is the 7 points. Now, if you don't get that, I kind of warned you about this. If you struggle with, like this trick here I'm showing here, then you're going to have to memorize that the maximum loss in a credit spread is the difference in the strikes less the net credit. I personally think that's a mental mess, but however you get there. So let me put that over here. We're going through our 8 things, and this is test item number 6. And let's put that in the right spot. Oh. So here's what I'm kind of saying here. What I'm saying is that we have this, we know this is 8. And so we know that it's got to be 8 plus something, and that's 7. Right, so we're doing our 6 things here. Let me just give you a visual representation. There is no graphing on the test. There is no graphing on the test. But, some people are visual people. Here's our apple at 160. Let me get it bigger. Right, here's the apple at 160. And here is the market price of Apple. And we're saying, yep. And we're saying that we only want to play between 160 and 175, and then we don't want to play no more. So we said, if we just have that 160 call, 160 or lower, it expires, we keep the money, we go neener, neener, neener. Yeah, but now we're putting in our ceiling, remember, so there's our 160 call. Below here, no intrinsic value. If it's 160 or lower, contracts expire worthless. And remember, we took part of our money from the 160 and we put in a ceiling, right? Remember, the naked call had no ceiling, but now we have a ceiling at 175. So let's put that in there. And that's the whole point, is we're saying we want to play between 160 and 175, and then we don't want to play no more. So we said that the total market action here is 15 points. There's 15 points that we made or lost, and we have collected 8 of it. All right, so here is our net credit of 8. And we're saying that our maximum loss is going to be this difference here. And put that in red. We said the gain and the loss is the difference in the strikes, 15 minus 8. That's our max loss. And this is our max gain. So I'm just giving you a visual representation of this, not testable. Just showing you what it looks like. Okay. What is testable? By the way, if I really want to get carried away here, I could put I could put minus signs here. And I could put plus signs here. That's what we're doing. We're, not testable. That's called the range. The range. The range here is 15 points. Okay, now the reason I thought that was kind of helpful is because our next thing, number 7 in our don't hate the 8 of the things we've got to be able to do on the test is we have to figure out the break even. Now, another test taking trick. The break even has got to be somewhere between 175 and 160. So on your test, if you shop the answer set, typically they're going to offer you like 158 and something like 177. And you can eliminate those two choices because whatever's on offer for you as a break even has to be a number somewhere between 160 and 175, right? Now we have 2 memory aid devices for break evens because we have call spreads and we have put spreads, right? Call spreads and put spreads. And so the break even we're going to be using our memory aid device is going to be cal. Now, by the way, before we turn this into a spread, you told me, and we went over the break even as being 171. Remember, if this was just the stupid naked call, that's why we said it's stupid, because somebody who does a naked call doesn't know about a credit call spread. But remember, when we had that, it was 171. It had unlimited risk. Your max gain was 11. And we were smart enough to say, you know what? We should just buy a 175 just in case. Now, what cal stands for is it stands for call add to the lower. Call add to the lower. So the lower strike here is 160. The lower strike, by the way, in the call spread will always be the dominant leg because lower strike calls always have greater premiums. So if you're trying to figure out what's going on. So we're going to take our lower strike, which is 160, and we're going to add our 8 points, and we're going to get our break even of 168. 168. Again, there is no visual stuff on the test, but we're playing between here and here, and our break even's got to be somewhere in between those two numbers. That's what's going on there. So let's just put that in our menu over here. We're going to take the lower strike. Now, I don't mean lower on the whiteboard we're looking at. I mean lower numerically, right? So, that's what I mean. So we're going to take 160. We're going to add the net premium. Doesn't matter what's a debit or credit. Doesn't matter, whatever that is, 168. Now I'm going to do, because you're doing a tutoring session, I'm going to show you a little something that I don't usually show people. Again, I don't mind showing you extras. So you're getting some extras. I just want to illustrate again that if you get good at a T, you can get good at not having to memorize everything. But the dominant leg here is my obligation to sell at 161. That is my dominant leg. And so what I could also do, if I don't want to memorize break evens, is I could just plug that into my T and say, well, my dominant leg is having to sell the stock at 160. That is my dominant leg, having to sell that. So ultimately, I need a break-even number that makes the columns balance. Mm-hmm. So if you get good at the T, you could say, okay, well, the dominant leg is my obligation to sell at 160 because the greater premium always dominates. And now you can just shop your answer set that, because they're going to offer you 4 choices and say, okay, I got to plug in a number that makes it balance. Because that's what break even is, same dollars out as dollars in. Let me plug A in and see if that works. Ding, 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 ding. Right, so the dominant leg. Now that's, by the way, our last thing we've got to be able to do. The last thing we got to be able to do, don't hate the 8, is determine whether the spread is bullish or bearish. Now, again, a lot of people just like to do it in different order. I don't care. I mean, you can do it any way you want as long as you come up with the right answer. I had a young lady, I admire her. She's so willful. I mean, I think she's going to do really well in our business, but she goes, Dean, I have my own method. I go, well, that's great. Everybody has different methods as long as you're getting the right answer. But then I had to counsel her. I said, listen, I hate to break the news to you, but the method you're using isn't working. So I mean, you got to have a method that works. So my point is not everybody's going to do the 8 things in order, or maybe they're not going to do the thing, but you got to have some kind of a process.
Yeah.
The 2 biggest things that you got to be able to kind of do is, track the money. Now I like to do here this process, but as I said, the larger premium dominates the position. So if we're trying to figure out what's going on, we always go for the thing that is going to be the greater premium. In this case, it's shorting a call. And that's important because that means a couple of things. It helps us know that we're going to make money if Apple's below 168. Right? We need to know that we need money. Here's our, again, our visual, and this is a bearish spread. But as we said, when we started out, this is a smart bear. There are smart bears and dumb bears, and this is a very smart bear because this bear is saying, I want to take that 11, but I don't want to have unlimited risk.
Mm-hmm.
And so this is just a smart way to be able to take that money without taking all that risk. All right, so let's go back now and let's do our 8 things we got to do, and then I'll show you a debit spread. Mm-hmm. And so as we said, we're just going all the way back here. Okay, so boom, boom. We said first thing we got to be able to do is identify a spread. Long and short, the same type of contract. We said the next thing we got to be able to do is determine whether it's a debit or a credit. And we said the way we do that is we net the premiums.
Mm-hmm.
We net the premiums. Now, once we get that, we can rock and roll because we either get credit, expire, narrow, or coming attraction, debit, exercise, wide. Right? We're doing a credit spread, and I'm going to show you a debit spread. So you got to be able to tell me it's a credit. Now, by the way, this is really a key piece of the analysis because if you get this thing right, you can rock and roll. You can go credit, expire, narrow. I got my gain. You're almost forced when you do that correctly to almost be able to run the rest of the menu, right? So that's going to be key. So that's going to be key. And the way we're going to do that is we're going to net the premiums, and we find out this is a credit spread. We said the next thing we got to do is tell us on the test, does your customer want these contracts to expire, or does you want their contracts to exercise? Well, you could say, well, gee, I know it's not exercise. Who wants to buy the stock at 175 and deliver 160? Nobody wants to do that. What I want is the contracts to expire so we can keep the money. And then wide or narrow, that's hard to do, but it goes together. We need the difference in the premiums to get smaller. We established it for net in 8. Net in 8. Right? So we're going to go credit, expire, narrow, or debit, exercise, widen. Now, this next piece of analysis is really key as well. We know that whatever the max gain and max loss are, they add up to the difference in the strikes. We've said that options are all about floors and ceilings. Floors and ceilings. There's a floor here at 160, a ceiling at 165. All the action takes place between the strikes. That's the whole point of a spread, is all that action is taking place between the strikes. Basically, what I'm saying is I want to play between 160, 175, and I don't want to play no more. So that's what's going on. So we said, now what we're going to do is go for the easy number. What I mean by going for the easy number, Lauren, is if it's a credit, I know it's my gain. And then I'm going to show you a debit, it's going to be the loss. And if you can get that first, easy pivot from that gain or loss, then you can again start rocking and rolling through this thing. And so I say, okay, well, when I collect money, the best case is I get to keep it. Apple's 160 or lower, I go neener, and I get to keep the money. And that would be ideal. So I'm going to plug that in. Now here, as we said, it can be a little bit of a struggle. Now, what I mean by that is I like to just look at it and say there's 15 points to be made or lost. I collected 8, so I can lose 7. That's what Dean likes to do. But if you don't know that, then you're going to have to memorize. I always tell people, if you go down the memory road, there's nothing wrong with that. But if you go down the memory road, there's going to be more and more stuff that you have to continue to memorize. Whereas if you can understand it, then you don't have to memorize so much. But if you don't get what I just did there, then you got to memorize that the maximum loss in the credit spread is the difference in the strikes less than that credit. Ugh. I think that's painful personally. I just think it's easier to say, it's 8 plus something equals 15. Now, again, if you get good, then you can look at it and say, if you get good, it comes with practice, drilling, rehearsing. What happens with options? Lights go on and they go out again. And they go on again and they go out again. So you gotta keep on getting lit. But if you can look at this and say, okay, well, I think the worst case here is I have to buy Apple at 175, deliver 160, I lose 15 points. And there's 8 in my account. So, that's the worst case scenario. That, but don't think about it until you get the menu done. Because the menu, if you do my menu, you got my guarantee, whatever they want to know, you've got the answer. And then I just showed you a visual representation of that. I said, there's our price of Apple, right? And we have a strike price at 160 and the market price of Apple, finite supply, infinite demand, could go to infinity. And so we had our floor here at 160 and we're hoping the contracts expire worthless. As I said, think you're kind of a jerk of a customer. Is the contracts expire, you say, hey, Dean, I wasted the 3 points for the 175, man. I said, well, Lauren, and we made 8 instead of 11, but we didn't take all the risk. I, Lauren, think making 8 and losing 7 is a much better risk reward ratio than making 11 and potentially losing everything. So yeah, we did spend 3 points to put in that ceiling at 175. And so now we're only exposed to 15 points of market action. And of that 15 points, we collected 8, leaving 7. Right? So that's what that spread looks like visually. We said the next thing we got to do is break even. We're either going to use cal or push. We're either going to do call, add to the lower, or put, subtract from the higher. I'm going to show you a debit put spread in a moment. I know you're excited. We're going to go through the 8 things again. And when we get there, the break even will be push, put, subtract from the higher. Such a great memory aid is call up, put down. Right? Call up. We're going up from the 160. Up from the 160. So I said one thing that's great about the break even is once you get this down, as we said here, you could toss out, you can almost get a 50-50, Lauren, by just knowing that it can't possibly be a number that's outside the range.
Yeah.
You can just say, it can't be 158, it can't be 177. So any numbers offered to you in your A, B, C, D choice, you could just simply go down there and eliminate 2 of the 4 right out of the gate. And then now you got a 50-50. I want you to write, but a 50-50 is better than 1 and 4, right? So here we're going to use cal, call, add to the lower. We're going to take our net premium, we're going to add it to the lower strike, and we get our break even of 168. And then the last thing we got to be able to do is determine bullish or bearish. And the way we do that is the larger premium dominates the position. The larger premium dominates the position, right? And the larger premium is that short call, and short calls are bearish. But again, you're not a dumb bear. You are a smart bear, right? Because you do a naked call, you get all kinds of risk. All right, so you said you wanted to do a credit spread and a debit spread. So now the test isn't going to tell you that I'm about to show you a debit spread, right? You're going to have to be able to figure that out on your own. But let's do it again. Let's leg into the spread, not testable. The conversation is not testable. Don't tell anybody. Don't tell anybody. But I want to buy this Apple August 160 put at 13, but I don't have 13 points. Damn. So it looks like I'm not going to be able to play. Oh, it's going down. It looks like, because my broker isn't going to lend me any money to do this. The other thing I don't like about this position, is I need 13 points. Remember here, I'm buying volatility. I'm buying downward volatility. So I have to be right that Apple goes down. I have to be right that Apple goes down at least 13 points to cover my out-of-pocket cost, 147. And I got to be right about all of this is going to take place between now and expiry in August, expiration. So I'm thinking, while I think Apple is going down, I don't think it's going much past 140. So what I'm going to do is I'm going to sell the 140s to help me pay for the 160s. The conversation isn't testable. What I'm going to do is lower my out-of-pocket cost by doing a spread. And so this is testable. We said test question number 1 is, can you identify a spread? And so we said a spread is when you're long and short the same type of contract. So we're about to leg into a spread, but before we do, is that 13? Is that dollars out or dollars in?
Dollars out.
Right on. Some people like to use debit. Some people like to use a minus sign, whatever floats your boat. You know, and I always like to get a T fired up. You know, I feel bad that, you know, I'm the guy who has to defend ways of doing things, you know. It's like, I feel sometimes like, you know, people like me who are tutors or people who help people, we're kind of like those cardinals in Rome who, you know, fight over theology and what's the right way to do things. And, you know, who cares as long as you get a right answer. But again, however you do it, if you get good at contract specifications and you get good at tracking money, you know, you're going to want to have 125 options. Now, I told you one thing I like to do, particularly as it relates to puts, because puts are kind of, you know, those upside down, backward kind of thing. So I always like to, when I'm looking at a contract, just say, what am I looking at? And what I'm looking at here is a choice to sell the stock at the strike price, particularly, you know, when I'm looking at put contracts. You know, kind of the way I think about it is I'm a putter. I'm the putter at 160. And remember, we're going to have putters. We're going to have put-ees. All right, so boom. I like to have that going on. And let's get this part going on. We got our, you've been pretty good at this. I'm very pleased as your tutor. Is this an opening purchase or an opening sale?
It is an opening purchase.
Oh man, I'm so glad you got that right, because then I would have felt guilty that I jinxed you. You know, it's kind of like those newscasters when I watch them basketball. Oh, he's made 13 free throws in a row. I go, oh my God, why'd you have to say that? You know? And again, if we wanted, we could put $1,300 in here. But I believe we should do things on a per share basis. So I'm going to put 13 in there. And let's boom. You know, by the way, the more you can be disciplined about a process, or what I call the setup. Now, what we're doing is setting it up. And if we set it up nicely, a lot of things will flow naturally through it. If we, you know, we don't do the setup, if we just kind of eyeball it or whatever we're trying to do, probably not a good idea. And then I said, we want to be careful, particularly on these advanced option strategies, that I like to be a little more disciplined about, you know, labeling things. So I know what, you know, later, if I'm looking at something, I don't forget what I'm looking at, right? In fact, to be honest with you, you could actually put your choice to sell here at the 160. You could put it over there if you wanted, I mean, or not do anything you don't want to do, but, you know. Okay, so again, the conversation is not testable, but I kind of like this now, because what I'm about to do is sell the 140s to help me pay for the 160s. And that would be, you know, if I can lower my out-of-pocket cost, that'd be nice, because I lower my risk. Don't worry about it. I'm going to talk about it. This is not testable, what I'm saying. And if I can lower my out-of-pocket cost, I'll also lower the amount of downward volatility I need to break even. Right now, I need Apple to go down 13. But if, you know, I didn't spend 13 points, I would need to go down 13. None of what I just said is testable. What is testable is to be able to identify a spread. And so now what I'm going to do is I'm going to sell or short one Apple August 140 put. Now, the reason I'm going for the 140 put, let's see if you're turning into a player. You know I'm going to be playing between the range, and here I want to have a big range, right? Because I'm going to be buying the spread. And so now I'm going to want to have lots of room for it to, you know, move. Again, not testable. But, you know, I'm selling the 140 puts, and let's say I get 7 for that. Okay, so boom, let's put that there. Okay, so again, what Dean likes to do is not testable, but particularly on puts, I like to say, what am I looking at there? That leg is an obligation
To sell.
to buy. That's why the puts are so important. You're the put E at 140. When you sell a put, dollars in, you're obligated to buy the stock. You know, again, I probably shouldn't be so loosey-goosey with you, my friend, but I call that a brain fart. You know, puts, as I said, are the ones that you got to be real careful on.
So, but they're first going to buy the stock, but because
Well, if you said this, and I owe you an apology, were you telling me, Dean, that we're selling the put contract? Is that what you were telling me? That's 7 we're bringing in over here. If that's the case, then you are correct. And I owe you an apology. That's an opening sale at 7.
I don't know.
So puts are the ones that are messy. So let's just go back here. Let's go back to the basics. Let's go back to the basics. That is a basic option position.
Yep. We have the obligation to sell. Or sorry, the right.
There you go.
The right.
Choice. Puts are always the ones that mess up. It's okay. People go, I don't get it. I buy it to sell it. I go, those are different hits, Lauren. When you buy it a put contract, you have a choice to sell it the stock. Those are different things, right?
Yes.
So
yes.
the puts, by the way, I'm purposely being a jerk here. I chose the puts. I chose to give you the difficult one. The other thing that people, I don't know if I should tell you about more mistakes people make, we don't be negative yet. The other thing people are going to mess up here a lot of times is they don't realize that the debit doesn't mean bullish. You got to do that separately. This is going to be a debit put spread and it's going to be bearish. Because what dominates, remember, is the larger premium. And what I'm really trying to do here is I'm trying to buy the put. Again, the conversation is intestable. But what I'm trying to do is lower my out-of-pocket cost. So in a credit spread, you're trying to cap your risk. In a debit spread, you're trying to alter the risk reward in your favor in terms of volatility you need to break even. Again, not testable. But what is testable is where, always have a dominant leg. We always have a dominant leg. And so what we're doing now, this is testable, is we're going to create a spread. And the spread is long and short, the same type of contract. So here we're long a put. So to create the spread is the difference in the premiums. We would have to test question sell a put, right? Because you're going to be long and short the same type of contract. Okay. That is testable to be able to identify it. So this is what it looks like. Test question number 1. That is indeed a spread. And remember the spread, let's just chance to redeem yourself, I guess, or maybe not. I don't know what you were talking about. That's 7. Remember, that's going to be money in. And some people like to call that a credit. And some people like to call that a plus sign. But remember, you're netting these two numbers because that's what the spread is. The spread is, again, the difference.
Yeah.
So we're spreading. This is a spread. Now we said the next thing we got to be able to do, test question number 2, we said, don't hate the 8. We got one of the 8 things you're held accountable for. You're not going to ask all 8, but one of those 8 could be testable. And, we get practice, drill and rehearse, and we do our 8 things and, whatever they want to know. And, sometimes once you get, then you can do it, without maybe doing the entire menu. But so now we're going to be looking at debit or credit. So let's put that here. And we said we get this, we can rock and roll. The way I think of it is like Nike, just do it, or like Mountain Dew, do the do, or like Dean, if you're wide, you need to exercise. I joke in some cultures, this is a sign of wealth and prosperity. Unfortunately not ours, right? But we said the neat thing about that debit, exercise, widen is we said that all goes together. So that kind of gets us halfway through our 8 things.
Because it's going to be a -8, right?
Yeah, that's right. So we're going to, 8 things are going to be, remember where we're going here is gain loss.
It'll be
we're going to have a break even.
-6.
well, be careful. You're getting ahead of yourself a little bit. So that's why we want to stay menu driven. So let's establish whether this is a debit or credit, your point, money out or money in. And the way we do that is we net the premiums.
We have more money going out than coming in.
That's exactly correct. And so that means that we have established that this is a debit or credit.
Sorry, debit.
That's right. Listen, it's been a long session. We're coming up on a couple hours. But this was on your menu, and I told you you've been kind enough to pay it forward with other folks. And so I told you we would finish this session hell or high water. Now, I always tell people when you're doing study blocks, I don't really think you should try and do options like 8 hours a day because you go bonkers at some point. So I always think about an hour and a half is max. Some people 45, maybe an hour and a half. And then what you want to do is take a half-hour break and then maybe do your parity we started this session on, or mix it up, do some margin. If you keep mixing it up, sometimes your brain will stay a little fresher perhaps.
Okay.
So, but that is really important because once we get that, we can rock and roll.
Say
Right.
debit.
Debit means more money out than in. More money out than in. Right. So if you wrote a check for $1,300 and then you made a deposit of $700, that would mean a net debit out of your account for, oh, it looks like Dean made a mistake here. That's not an 8.
The 6.
Yeah. So bad Dean. Now, by the way, the good news I said is about a process. If I have a process, I would have caught myself. I caught myself there, but I would have caught myself somewhere down the road because it wouldn't work. Right. So that's the other good thing about having a process, because if you have a process, it allows you to do your own kind of diagnostic on the fly. In other words, you're shopping the answer set and you go, well, geez, it's not working. So yeah, so let's do that. Let's fix that. I told you, Dean, arithmetic, I should have used my damn calculator. How embarrassing is that? 13 minus 7, 6. That is embarrassing. But hey, that's part of life. So I'm going to put 6 there. And, again, we're going to stay menu driven. So we're just going to leave this there for now. But if we think about this exercise would be great. You know what? Let me just walk you through that again. Conversation is not testable. All the actions taking place between there. So somebody sticks it to me at 140. Somebody sticks it to me at 140. I'm the put E at 140. But I'm the put at 160. So I'd be happy if this is in your account. I say, Lauren, you got exercised. That means somebody stuck it to you at 140. You go, oh, damn. I go, whoa. Lauren, then we're going to stick it to the next guy, 160. You say, oh, I make 20 points. I go, no, you don't make 20 because you spent 6 to get rolling. So you don't make the entire 20. But the gain and loss always equal that number. Now, the hardest part to get, as we said, is this idea of widen or narrow, but we need to be able to close this out and get more than 6. If we can close it out for a difference of 9, if it widens from 6 to 9, we'd make 3. It's the hardest part to get. We don't need to get it because this goes together all the time. Do the do. It goes together all the time. Okay, so next thing we got to do is we got to do our gain and our loss. Now, do you remember what I said about gain or loss? I said, what you might want to do is pivot to the easiest thing. Okay. And what I meant by the easiest thing is in a credit spread, to me, the most transparent, easy number for me is what I've collected. In a debit spread, the most transparent number to me is the money I spent. And we said when you're a speculator in options, when you collect money, best case is you keep it. Neener. And we said when you spend money, the worst case is you lose it. And this is kind of bueno here because I've lowered my out-of-pocket costs from 13 to 6. And so now I only lose 6. I'm still a loser, but losing 6 is better than losing 13. So in a debit spread, the maximum loss is your debit. What you spend. Let's put that over here. Boom. So we had debit, we have credit. This is a debit spread. And we said in a debit spread, your max loss, that's what we're doing now, is max loss is the net debit. So pretty easy to qualify somebody who wants to do this. I say, Lauren, do you have $600 that you can afford to lose?
No.
Well, I'll do it, right? So, I'm teasing, but not really. Whether you want to buy a call or buy a put or buy a spread or buy a straddle for that matter, it's pretty easy to qualify somebody as this money you can afford to lose. And your point for everybody, that's a different number. I call this your play money, and for everybody that what is their play money is a different number, and we need to make sure that we're not losing your real money. I found people don't get mad if you lose their play money, but if you lose their real money, they're gonna, the biggest one-time loss I had somebody take in options was a little over $100,000, and his name was Mark, and then he said, well, Dean, I could use the loss this year. I go, geez, Mark, I wish I lived in your world. In my world, that's a lot of money.
Oh, geez.
So for everybody, it's a different number, right? All right. So, but by the way, it's better than losing 13 is the point. Okay. So now we want to do the max gain. And we said one of our tricks, or kind of one of our things, is we said that whatever the gain or the loss is, it always adds up to the difference in the strikes, because we want to play between these two numbers and then we don't want to play no more. Right. So that's something we can kind of hang our hat on in terms of a test taker. We know that the gain and the loss equals the difference in the strikes. Right. So there's 20 points to be made or lost. Let's label that. And then we said the other thing that's kind of that I'm hoping that we don't have to do is memorize as much stuff. The less memory work we can do, the better. But what I mean by that is if you don't get to 20 plus something, 6 plus something equals 20, well, then you're going to have to memorize again. And I just think it's a mental mess to have to memorize, all this stuff. I just think it's easier to say there's 20 points to be made or lost. Difference in the strikes less the net debit. That's easier. But however you get there, you need to get there. By the way, once you get it done, you can think about it, but don't think about it till you get done. So that's our max loss. So this is going to be our max gain. And let's label that. The gain and loss always equals the difference in the strikes. So as we said, as a test taker, you can eliminate any two numbers that don't add up to 20. Kind of a test taking trick. Here we go again. Here we go again with a visual representation not testable. A visual representation not testable. So here is our 160 put. Let's put that in black. Right. There's our ceiling at 160. That's our strike price right there. Boom. Let's make that a little bigger. And how far down could Apple go? How far down could Apple go?
To 0.
But remember, the whole point in a spread is we're saying we don't want to play between 160 and 0. We're saying that we want to play between 160
and 140.
Yeah, and then we don't want to play no more. Now, of that 20 points, because we said the gain and the loss is going to equal those numbers, right? And so that means the break even, we're not at the break even yet, baby steps, but we know that the break even has got to be a number somewhere between here, right? Between the range, not testable, but that's called the range, right? We do know that we spent 6 to get rolling. So let's put that there. And we said that when we spent that 6, that was our max loss. And we said the gain and the loss is always going to equal.
Yeah.
right?
The different strike prices.
Yeah. We're saying we only want to play between 160, 140. We don't want to play no more. All right, so we've done now, we've identified it. We've determined it's a debit. We've said exercise, widen. We've got our max gain, our max loss. We said our gain and loss always equals the difference in the strikes. Right, so there's our 20, and this was 6. So that means it's going to be 14. All right, so now we got to do our break even. Now, test taking trick again, we can eliminate on the answer set anything that is outside the range. The break even has got to be somewhere between these two numbers, right?
Mm-hmm.
So our two memory aid devices are call up, put down, or as it relates to spreads, cal and push. Cal and push. Cal and push. And what does that stand for? Push.
Put, subtract from higher.
Oh man, you are on fire. You are correct. Now, by the way, it doesn't do any good to have these memory aids and not know what they're used for. Right? So that can be a little disconcerting when I know there's some trick here. So, you are correct. So, by the way, if you get with practice, drilling and rehearsing on the menu, at some point, I think it will become a little more transparent to you in terms of the less memory work. In other words, if we're looking at this thing right here, at some point, we got to say, well, gee, it looks like it's got to be, put subtract from the higher to get there. Right. So we're going to take our higher strike, and here our higher strike is 160.
Mm-hmm.
And we're going to subtract the net premium. Doesn't matter whether it's a debit or credit. In this case, it's a debit put spread, but it wouldn't matter if it's a debit put spread or credit put spread. The break even would be the same. What would be different is whether you want it above or below that number. What would be different is whether you're bullish or bearish, but it's 160 minus 6. By the way, not testable, but that's a hell of a lot better now. I only need 6 points of downward volatility. Before, I needed 13 points, but by selling the spread, that lower strike put, I have altered that. And now my break even, let's put that in here, is 154. Boom, let's put that here. That is now our break even. Okay, so before we move on our break even, we have some relevant numbers now. There's no, test question about visual stuff, but in terms of visual, here's our 160. There's our 140. That's where we're playing between, right? There's our break even. Right? If I wanted to, Dean could, if I want to be clever, I could put my minus signs in here. Right? And I could put plus signs once I cover my out-of-pocket cost. These would be pluses. Let me go back. I want to get smaller things. I can put more pluses and minuses there. So minus, whoop. Oh, come on, Dean. There we go. Right, that's what it looks like. And then this would be pluses. Whoop. And I'm going to change the color to green. Boom. All right, the last thing we got to be able to do is determine whether it's bullish or bearish. Do you recall how we determine whether it's bullish or bearish?
The larger premium dominates the position.
So right on. And so the dominant position is buying a put. Now, the reason that's important is because we need to know where we want the apple to be in relationship to this.
If we want the choice to sell it, we want to sell it at a higher rate than what we bought it. So we would want to sell it at a different price than the market price.
That's right. Now, remember the trick I showed you too for your break even is if you don't want to remember cal or push. Now let's just make sure we put in here what this is. This is bearish, meaning we want to go down.
By the way, another smart bear, because whether you're long a put or long a put spread, debit put spread, when you're long a put or long a debit put spread, you buy a put thing. As a bear, if you're wrong, you're just going to lose here 6 points. And that's a lot smarter than being a dumb bear, doing a naked call or doing a short stock position. If you short the stock, that has unlimited risk. So, not so bad. Now, the other thing I said you could do is to know the dominant leg is 160. Okay, take a deep breath. So that's the dominant leg, and that is a choice to sell the stock at 160. And so if you stick it to somebody at 160, that's another way to get the break even. Because the break even is the number that if you plug it in there on the other side would make the columns balance, because that's what break even is. Same dollars out as what?
Dollars in.
And so, you could shop your answer set, as we said, and know that if you plug the number in, it's got to be something that would make it balance. And so if they offer you choice A, says the break even is 154. By the way, remember we said as a test taker, we're eliminating anything that isn't in the range. If we plug in our dominant leg and we say, okay, let me try that. By the way, you could go through all 4 answers, plugging them in until you get something that makes the columns what?
Even.
Yeah, because that's what break even is, right? Now, some people, again, like to net their columns. I don't typically like to net the columns because I then confuse myself about numbers that were in the question and numbers that I've made up. So, but that's something, you can decide whether you want to try and net those. All right, let's go back to the very beginning. So we are concluding our tutoring session. What a session this was.
What session, right?
Another winning session. And so we started by doing parity. You said in your punch list, you said you wanted to do convertibles. I don't know if you said parity. I think you said convertibles. But let's be clear. Next time you'd say parity, because that's what you got to be able to do is parity. And then you said you wanted to do a credit and a debit spread. And so we have done both of those. What I didn't show you a debit call spread, and I didn't show you a credit put spread. I kind of gave you a version of what I thought would be reflective of what you're going to do. And we got our menu. And so we said test question number 1 is, can you identify a spread? And we said it is when you're long and short the same type of contract. We said test question number 2 is, can you determine whether it's a debit or a credit? And we said the way you do that is you net the premiums. You net the premiums, right? So we netted the premiums and we established that this was what happened? There it is. Oh, there's Dean's 8. No. It was an 8. It was 6. There we go. Caught myself. And we said we want to play between 160, 140. And we said now we got to be able to do our gain and loss, which always equals the difference in the strikes. We said I always like to pivot to the easy one. So we said in credit spread, I think it's easy to think of my gain and the difference in the strikes less the net credit being my loss. But those 2 numbers always equal the difference. And so we got our 2 numbers are 20 and we have 6. So 6 plus something is 20. What is that something? Now, after you get good again, then you can think about it. You could say, if you're menu driven, you say, okay, if somebody sticks it to me at 140, I'm the put E at 140, I'm the put at 160. Yeah, that sounds bueno. I'd make 20 points. Sounds good. Spent 6. I'm a winner. I told you I went a little overboard in your tutoring session with you, Lauren, for a couple of reasons. One, I think you can handle it, right? So, and you don't want to just pay for a replay of a YouTube video. So I did show you some visual representations. I want you to be clear, there is no graphing on Series 7. And if the visual representations cloud your mind, then just let it go. But here was the visual representations of a spread in terms of what happens to the price of the stock. And the whole point why I did that is I wanted to show you this idea about floors and ceilings, right? There's a ceiling at 160 and a floor at 140. All the action takes place between those 2 numbers, right? So that's why I went ahead and showed you that. And we said it's kind of nice too, because even if we don't have cal or push, we know that the break even has got to be somewhere within the range. So there's 2 kind of test taking tricks. We know that if we're looking at a spread, the gain and loss has to equal the difference in the strikes. So if I ask you max gain, max loss on a spread, Same thing. You can look at the answer set and top out anything in this case that doesn't add up to 20. Whatever the two numbers are, they got to add up to 20. By the way, that's usually going to be two choices. Like you'll have one that says 6 and 14, one that says 10 and 10. You know, so it's got to be two numbers that add up to that. That's a nice thing to kind of be able to get to a 50-50. And we said another great thing about this in terms of getting to a 50-50 on the break even is you can toss out, even if don't know cal or push, you can toss out anything that isn't in the range between the floor and the ceiling. We said put subtract from the higher. We got our break even at 154. And so there's our range. 160 to 140 is the range. And we said that break even has to be a number between there. Somewhere between there lies the break even. But by the way, it's kind of bueno because without the spread, our break even was 160 minus 13. But now it's 160 minus 6. We only have to cover 6 points out of pocket. So that's kind of bueno. And then we said the last thing we got to be able to do is determine bullish or bearish. And you were correct. The larger premium dominates the position. It'll always be the higher strike put. Higher strike puts always have greater premiums. And in a call, it'll always be the lower strike call because lower strike calls always have greater premiums. So, it's going to be the higher strike put. What I'm hinting at is if that had been sell the 160 and buy the 140, it would be the opposite, right? That would be a dominant leg and it would be bullish. There we go. We determined it was bearish. And we said another trick I showed you in this tutoring session that I'm going to regret. Not because of you, but because it's a new trick that I don't usually show people. And now it'll be out there living in the universe and everybody's going to try and start drawing graphs and trying to do boxes. But I said that if you know the dominant leg, you can plug it into the T, assuming you plug it into the right side of the T, right? In other words, my dominant leg here is a choice to sell the stock at 160. So if you're using the T, you could plug that dominant leg, the exercise strike price in there, and then you can shop the answer to that. It's another way to get to break even besides cal or push. And we said we could shop our answer set, plug numbers in there until we get one that makes the columns balanced, because that's what break even is, same dollars out as dollars in. Okay, woo-hoo-hoo.
Got it.
That was a long session. Okay. Anything else on your mind
No, I
today?
just gotta absorb that and put that to some
I
practice.
think that's right. So just don't look at the question. When you get a spread, just go to your menu, do your menu, then go back and you'll see that whatever they want to know, you've got the answer. Right. So that's how I would suggest attacking that. And then I think we see each other again at some point in the future, I think.
I'm not sure if I have one
Oh,
booked
if
for
you
next
don't,
week.
okay. Well, I thought I saw you, but maybe not.
Maybe. I don't have one on my calendar, but
Okay.
we will see each other again.
Okay. All right. I'll see you later. You know where to
Okay,
find
see you,
me. If you
Dean.
don't book tutoring, keep in touch. Let me know what's going on.
Okay, thank you
Okay.
so much.
You bet. Bye-bye.
Bye.